Welcome, everybody. We're excited to have you on today. We thought it would be good to go through 2021 Social Security updates. Tyler does presentations all over Utah and some other states every once in a while on Social Security. So Tyler and Mike in particular spend a lot of time educating on Social Security strategies and really staying up on what laws have changed and anything that you should know and be aware of. So excited to have Tyler here today. We're recording this, so it will be available on thefinancialcall.com/webinars. We put all of our past webinars up there as well. So if there ever was a webinar that you missed, that you hoped you could have listened to, it's there. We just got into putting things on YouTube, which makes us feel younger, but then we don't know how to do it, which makes us feel older at the same time. But we're trying really hard. But anyway, we're taking these webinars and even dissecting them into little short clips based on little pieces of information, so it's easier to consume in 5-minute segments, 20-minute segments, and the whole presentation is up there as well. So this one will go up as well. I expect this will also be an episode of The Financial Call. It's a podcast that I run, talking mostly about retiree strategies and how to better prepare for, transition into, and live in retirement. We do cover a wide array of topics, everything from kind of the nerd geeking out tax strategy to where are the best places to travel in retirement. We had Larry Gelwicks on, the travel agent, talking about that.
Getaway guru, right?
Yes, exactly. The getaway guru. That was a good one. We had the Jazz Bear on talking about his transition away from being the Jazz Bear and into retirement. So a lot of fun conversations there as well. Today is going to hopefully help you realize that there are some things that change every year with Social Security. We were talking about this earlier. We definitely don't want people feeling the huge pressure of, oh my gosh, what's changing? And I need to hurry and change everything with my Social Security strategy. Every single year, most of these changes happen. But this is nice to know what's actually going on. So Tyler, I think we'll just dive right in. Is there anything else you would add to that? We've got, usually get a couple hundred people on these webinars. So if you have questions, use the functionality built into the webinar. There is a Q&A and there's chat, and I'll try to watch both of them. So just send it over however you want, and we'll make sure to tackle it. We have found that during these webinars, it works out better if you just ask questions as we go rather than saving. I actually hate in the end, where they're like, we'll save this much time for Q&A in the end, which we will try to do. But I'd almost rather just, if we're on that topic and you have a question about that topic, throw it in.
Yep.
If we think we're going to hit that question later, we'll probably address it later. But anyway, let's...
Sorry, let me mute real quick.
You're good. We'll just tackle them as we go. Somebody asked, where can you find the webinars? It is on thefinancialcall.com. That's my website for the podcast and the blog and anything finance educational. Thefinancialcall.com/webinars. Or if you can't remember the /webinars, up in the top right, there's free resources. So just get to The Financial Call, Google that. Top right, there's a button that says free resources. And one of the options in that section is client webinars. So you'll find it there. All right, I think we dive right into it, Tyler, and you can take us away. Let's get in. I'll get us started on the agenda at least, and then from there, we'll go through and answer questions as we go. So agenda, what we're going to cover today, we want to jump right into the announced changes for 2021, just in case you can't stick with us for the full time. Let's give you the meat right at the beginning, and then the rest is just going to be really good content, but at least you got what you came for right away. So announced changes in 2021. People are always wondering about the health of Social Security and will it be there for each of you? So that's something we want to address. And then we thought we would do a really quick refresher on the basics of Social Security, because over the last 2 years, we found that there are two major common mistakes that people are making when making their Social Security decisions. So we'd like to give you at least the basics so that then at the end you can understand what these mistakes are and how they're made. So let's get into it.
And Zacc, before I jump into this, I just wanted to mention I had an experience this morning that I wanted to share that got me thinking about this, because I knew I was going to come and present, and it got me thinking about all of our clients and their retirement situation. So got in my truck, and realized that my right front tire was at 19 PSI.
And you realized it because you have a fancy truck that tells you. You realized it.
Yeah. Luckily, the truck told me, right?
Okay.
It's like glaring in my face. You have 19 PSI in this tire, and the tire's supposed to be at 40. And so I'm kind of in a panic because I'm thinking, I gotta hurry in, and we've got to prepare for this webinar. And I was able to quickly stop by my local discount tire and get my tire filled. But it just got me thinking about retirement and how, as we go through retirement, there's all these hazards in the road, right? For me, it was a nail in my tire, and apparently it's not good to be driving freeway speeds with a nail in your tire. So I've heard, but it got me thinking about our retirees and Social Security is one of these massive hazards in the road that if it goes unchecked, if you don't take the time to really, do your due diligence on your strategy, your specific strategy, you could run into some major problems. So today I'm just going to go through some of the changes. Here's the 2021 changes for Social Security. Cost of living adjustment. Every year, Social Security has the chance to go up with inflation. And this year it was 1.3. Can we just show Zach the next slide? Let's show, these are the COLAs dating back to 1975. COLAs were instituted in 1975. Prior to this, there was no inflation adjustment. It was just a stagnant benefit. But in 1975, they decided, hey, we're going to actually increase this benefit every year to allow retirees to keep up with the cost of living. As you guys know, as you move through retirement, things just go up in cost. Things are more and more expensive, and it's deflating your spending power. And so the COLA was instituted to allow you to keep up with the cost of living or the cost of goods going up in retirement.
And a lot of our clients talk about the 80s being high inflation time periods, which they were, and interest rates in the double digits. I cannot imagine the Social Security Administration saying, hey, next year's COLA is 14.3%, like they did in 1980.
That's interesting though, because in all of my presentations, I ask, what were interest rates back? What were you paying on your home mortgage back in 1979 and 1980? And the common response I get is 15, 18%. And so these COLAs do a fairly good job of keeping up with inflation. They're not perfect. We can see that, but they do a fairly good job, and we'll take what we can get here. You'll notice over the last decade, dating back to 2009, we have had 3 zeros. Those were years when inflation was fairly stagnant. We didn't see a high inflationary time, and so we just didn't get a COLA. But the 1.3 that we received this year is the second lowest of any increase. So in 1986, we had a 1.3, you'll notice, and in 1998, we had a 1.3. Those are the two, the second lowest in inflation adjustments. 2016 was the lowest positive increase, 0.3. But on the right here, you'll notice the averages. The 10-year average is average 1.65, the 15-year average 1.86. And over the last 20 years, it's averaged 2%. So to think that you've got a benefit in retirement that is going to last for the rest of your life, but also goes up with inflation at an average 20-year rolling rate of 2.04, that's
not bad.
Fantastic.
Yeah, not bad at all.
We'll take it.
Did I get any? Is there anything else on this one? Oh yeah, let's go back. Yep.
I'll keep going here. This effect, the COLA goes into effect in January, so you'll see that next year. I already mentioned it's the second smallest of all positive COLA years. Medicare Part B, for those of you who are 65 and older and on Medicare Part B, the premium for that has gone up to $148.50. So it's a $3.90 increase from last year. It was $144.60 last year. So you'll see a slight increase to your Medicare Part B. And Zach, a lot of people don't realize this, but if you're not on Medicare Part B, you're not quite sure how you pay for that in retirement. But for those of you on Social Security and on Part B, you know that this is deducted directly from your Social Security benefit.
Yeah, and then the last one there is the max benefit of any full retirement age retiree, $31.48. Can you explain how somebody gets the max benefit here, Tyler?
Yeah, so they calculate your benefit by taking your top 35 years of work. And then if you've been a really high income earner, you've essentially maxed it out. So it's rare that I see on a Social Security statement a benefit of $3,148. That is very rare, but it does happen. And to be clear, this is for anyone turning full retirement age this year. So 66 and 2 months this year. This could be the max benefit you're entitled to. Now,
we do see numbers that are higher than that, and that's because they're not turning 66 this year, right?
Absolutely. We see it. If you're younger than that, your max benefit once you do turn full retirement age could be higher. But also for those retirees who have decided to delay their benefit, maybe as part of a strategy that we've put in place, we encourage them to spend other assets from the years of 66 to 70 to allow this benefit to grow. And I've seen this benefit for someone who's deferred it to 70, who's a max earner, $4,500, $4,600 a month with the cost of living adjustments and the 8% delayed credit. So there's a lot of power to this benefit.
That's huge. Hey, we did get a question. If somebody is starting Social Security and strategy starting their Social Security strategy in January.
Yeah.
They're wondering, and they've already been told their amount, is that pre-COLA or after the COLA that happens in January? My gut tells me the number that they've received so far is before the cost of living adjustment, and that everyone's numbers will flip and change, and she'll probably get a little bit more than what they've told her.
Yes, I would suspect so.
Yeah. Okay. Great question.
The last thing I was going to mention on this slide, Zacc, this average benefit here. So across America, they look at all of the benefits, average amount, $1,543. And what's interesting about this is if you look across America, 3 out of 5 retirees, Social Security represents half of their take-home pay in retirement. And if 1,543 is the average benefit, it's amazing to me how important and crucial this benefit is. And so making sure that you have a proper Social Security strategy is critical. Again, I talked about the hazards at the beginning. You can't just go through retirement and hope that your plan works. You've got to do some planning in advance.
Right. Right.
So the average benefit that I see here in Utah, as we've worked with hundreds of retirees, I would say the average that I see on statements is about $1,800 to $2,200.
Yeah, we're also a little bit blinded to the fact because most of the time people come to us because they've made more money and they've been able to save money and need help with that money in retirement. I do think we have a view of only a certain number of, like, the more wealthy people in the state. I think that's probably why we see that $1,800 to $2,200.
It's very valid.
Social Security benefits there. We did get a question. So there was a question about family benefits, spouses, and disabled childs. That's one that I would talk about on a different, we'd be happy to take a one-on-one call on that one, but anywhere from like 175% to 188% or something like that of your PIA. That's a really complex one that would take about a half hour to go through depending on each unique situation. Give us a call. We could work on that one together. Somebody said, I turned 70 in February. When should I apply for Social Security? Whatever you're doing, you can always start the application process 3 months prior to when you want it. So if you're starting, you want to start receiving benefits in February, now's the time. You can do it at any time and just elect that date. Great questions here.
And Zacc, just to clarify, they turned 70 in February, or they turned last February?
Will turn.
Okay, good.
At least, I mean, it says I turn. I assume that's will turn.
Okay, good. Yeah. I say that because we do see some retirees wait to file until after 70. I cannot make this more clear. There is absolutely no benefit to waiting past 70 to file. So you've got to be on benefits by 70. Make sure that you get that application filed soon so you can start benefits in February. You don't want to go any longer than February on that benefit.
Yeah.
But great job delaying it.
Right. Now, the other question is, if that person's married, see, this is where Social Security is so personal. Like, we start to think about, wait a second, are you married? Have you been married? Is the person that you were married to alive or dead? Like, all these things start to say, like, hey, wait a second, maybe you should be actually picking up a benefit right now if you're not. And we might be able to backdate that at least, up to about 6 months. Anyway, there's a lot to that. This is that's a one-on-one call. Let's go through. These are the earnings limits for someone who is not yet full retirement age. Tyler, help us understand this.
They call this the earnings test. Essentially, if you try to file, or if you do file for Social Security prior to your full retirement age, we'll show you a full retirement age chart here in a minute that will show your year of birth and the age at which point you can file. They term it your full retirement age without any penalties. So if you're under full retirement age, and for most of you on this call, it's going to be 66, the Social Security Administration says, hey, you can only earn X number of dollars per year. This is earned income. It's not investment income. It's not real estate income. It is earned income only. But you can only earn up to $18,960 per year or $1,580 per month while taking Social Security benefits. If you're earning more than this, there are penalties. And the penalty is for every $2 over this amount that you earn, they will take back or claw back $1 of Social Security. So what I always tell retirees is, listen, if you're earning $40,000 to $50,000 per year and you're under full retirement age, it probably is not wise for you to take Social Security because you're over this earnings limitation. That changes in the year that you turn full retirement age. We keep using this acronym FRA. That stands for full retirement age. But in the year that you turn full retirement age, that earnings limit goes up. And so let's just use it as an example. Let's pretend that you're going to be full retirement age in July of 2021. Well, from January to July, because that's your full retirement year, you can actually earn $50,000 or $4,210 per month in each month leading up to July. And then once you've turned full retirement age, there is no earnings limit. And so, if you were turning full retirement age in July of 2021, beyond that point, you could file, collect your full Social Security with no earnings limit. But it's just those months leading up to July that you would be limited to $4,210 per month. And what would happen is for every $3 over that amount that you earned, they're going to take back $1 of your Social Security benefit. So they do give you a little bit of a break in the year that you're going to turn full retirement age. It's critical that you understand what your full retirement age is because a lot of people think that, hey, it's just 66. Well, that's not the case. For most of you, it's 66 and 2 or 4 or 6 or 8 or 10 months. And so you've got to be very clear of what your full retirement age is. Social Security does have a mid-year retirement rule. Again, let me use the example of a July full retirement age. If you earned, let me take a step back. Let's say you're 65 and you retire at 65. Any earnings prior to that don't count. So you could retire at 65, file for Social Security mid-year, and as long as you don't have any earnings past that, you're okay. It's the earnings prior to that they would be watching, but those won't count once you've filed for Social Security.
Yeah, great point. It's month to month. That's a good point. Okay, so this is now on the earner, the worker, how much they pay in Social Security taxes. This has not changed from a percentage standpoint. It's still 12.4% payroll tax of all wages, 6.2% paid by the employer and 6.2% by the employee. So once you hit the maximum, then you stop paying into that. That maximum has changed. It's gone up to $142,800. So that's something to be aware of. Going back to 2016, I remember thinking just chuckling a little bit at this because they gave all the recipients an increase of 0.3%. And they raised this number right here, this 142. It was actually 128, and they moved it up into the 130s or something like that. I can't remember. Maybe it was 122 and went to 130s. But the bottom line is that number went up by about 7%. And to me, that was kind of a way of them saying, well, Zacc, you're experiencing 7% inflation, but your dad is experiencing 0.3% inflation. Like, wait a second. Hold on for a minute. This is and we'll talk about the health of Social Security, but I think that's another lever that they can pull that nobody even knows that they even pulled that lever, and it helps. Yeah. So let's get into that, into the health of Social Security. We get this question all the time. Will Social Security be there for me? Tyler, you talk about this a lot. You study it a lot. Maybe you could give us some details. We have some trust fund balance info here. Let us know your opinion. What do you think, and help us through all this?
Yeah, I wish I had a crystal ball. I wish I could tell you exactly what the future holds. We won't know the 2020 stats until January, but these are a little outdated. But as of the end of 2019, so just 12 months ago, the status of the trust fund, the balance there was 2.897 trillion. The good news is we had a net increase in assets. So last year, there was $1.062 trillion of income, benefits paid in or taxes paid in, and interest earned. And the expenses were 1.059. So there was a $3 billion net increase to assets. That's all good news, right? But the way that we're trending right now with all of these baby boomers that are retiring on a daily basis.
We don't have any of those on this call.
We don't, no.
It's like 100 and something full of baby boomers here. Be careful what you say is what I'm saying.
That's right. There's 10,000 of you retiring every single day across America. And so as you leave the workforce, that 12.4% of payroll tax that you've been paying in Social Security tax, that's all of a sudden, it's gone. It's no longer paid. And we can't get enough of our generation to work, right, Zacc?
That's also true.
It's these millennials that
we're the worst. We're living with the baby boomers, right?
That's exactly right. So as those payroll taxes go away, all of a sudden we start to see this balance go down. And this next slide here just kind of gives you a quick chart of what that looks like. Do you want to flip that slide for me?
Yep. Hold on. Sorry, I got a good question here. Okay, I'm moving on.
So what this is showing is that in 2035, they're projecting that they're going to have to reduce benefits by 20%. 80% of benefits would be payable in 2035. Now, I don't anticipate this happening. There's lots of reform proposals, which I'll show you here on the next slide. There's lots of things that they're talking about doing that will help secure or shore up the system. Every candidate, every presidential candidate, lots of different individuals out there have ideas of how they're going to fix it. I saw, President-elect Biden has discussed his plan, and what he wants to do is phase people back into that payroll tax at anything north of $400,000. So you would, as we showed on that previous slide, you pay that payroll tax 6.2 as the employee on 142,000.
Yeah, go ahead.
142,000 of income, and then you stop paying after that. But what would happen with Biden's plan is that you'd phase back into that at anything north of 400,000. And all of the projections that they've run on that shows that would shore it up until about 2,100.
Yeah, that would be massive. If you think about all the, the amount of money made by the top earners above 400 is huge. And if they put a tax on all of that, I mean, people might get creative in finding ways of not showing income, but bottom line, that would definitely make a big difference. I think there are a lot of levers, again, that they can pull. Should we talk about some of them here?
Yep.
So I mentioned, they can change cost of living adjustments, change how much of people's income gets shown for Social Security taxes. That's that first one, increase the maximum earnings. We don't even have Biden's idea here on the list, but they could phase people back into it at a certain level, like 400. And Tyler, you keep going on this. You follow this better.
Yeah, raising the normal retirement age for those of you born between 1943 and 1959, your full retirement age is somewhere in that range of 66. They've talked about maybe pushing that out. Well, let me take a step back. Anyone born 1960 or later, it's 67. And I anticipate that moving forward, they'll continue to push that out. And the reality, Zacc, for me and you, I mean, we could be sitting at 70 as our full retirement age by the time we get there.
Right.
But that helps the system. The other thing here, lowering benefits for future retirees. This could affect our generation where they just change how benefits are calculated. Right now, it's your top 35 years. They could completely change that, and that would enhance the system. And then the last thing here is changing how COLAs are calculated. That could also improve things. So there's things on the table that Congress is talking about. Congress is the governing body of Social Security. They're the ones making the decision. I don't anticipate, Zacc, that we're going to be sitting here in 2035 biting our nails thinking everyone's going to lose 20% of their Social Security income. I just don't anticipate that. Again, I wish I had a crystal ball, but as we make plans for retirees, we're planning on Social Security being the foundation of their retirement plan because we're confident. We're confident that it's going to be there in some form or fashion, to the extent that it is today.
Yeah, I even think it'll be there, like you said, in some form or fashion for people in our age group.
Yeah.
Might be means tested out of it. We might not get it because we've saved other assets. But for those who are in their late 50s to 70s, I wouldn't stress at all about it. There are too many levers, too many things they can do, too many adjustments they can easily make and shore this up. And there are too many people voting for that. There's a lot of political will behind that to make it happen. All right, so let's do a quick refresher. And I don't think we need to go into crazy detail here. I'm hoping we can spend the next 5 or 10 minutes on some of the basics and then 15 minutes on biggest mistakes and then just answer some questions that come through. But we've already talked a little bit about this. Social Security has lifetime income. You get cost of living adjustments. There are what are called spousal and survivor benefits. Tyler will talk a little bit about that. You can get a higher benefit for delaying. They call those delayed credits. And there actually are some tax advantages of Social Security income compared to other income. So let's dive into that. Somebody did ask in the Q&A what FRA stands for. It's full retirement age.
Okay, so this is your full retirement age here. Find your birth year there on the left, and the age to your right is the age at which point you turn full retirement age in Social Security's eyes. This is the age at which point you get your full Social Security benefit unreduced without any penalties. I think on the next slide, we have just some consequences of filing early. One of the biggest consequences that you should be aware of is a reduced monthly benefit. So if you file early, 62, 63, 64, 65, and your full retirement age is 66 in that middle column there, you're not going to get 100% of your benefit, the age 66 benefit that you're entitled to. It's going to be reduced. And at 62, as you can see here, 25%. In fact, for those born 1959, you turn 62 this year. And we need to update this slide a little bit because the penalty is actually 79%. So, there are some consequences here. Reduced benefit is the number one that you should be aware of. The second one is that I've already mentioned, earned income limit. If you're going to file at 62, not only are you going to be penalized on your monthly benefit, but then you're going to have this income limit. $18,960 is the limit for 2021, to where if you earn more than that, for every $2 over, they're going to take back $1 of this monthly Social Security benefit. So it can kind of be a double penalty there for those that are still working. On the next slide, we'll show you once you've turned full retirement age, you get 100% of your benefit. There are no monthly reductions. And the cool thing is that you can now work as much as you want. There is no earnings limitation.
Yeah, a lot of people are saying, that's not cool. I'm done. I don't want to work anymore, right? But no, but we do see this a lot where people, all of a sudden the handcuffs are off in terms of taking their benefit while they're working, which is nice. All right, Tyler, let's do some quick basics on spousal benefits and strategies here.
Yeah. So in this scenario, we've got John and Jane. John's benefit is $2,000. PIA stands for primary insurance amount. That's just an acronym that the Social Security Administration uses to identify what your full retirement age benefit is. And Jane's PIA is $800. Now let's pretend that these guys are both 66. And when they walk into the Social Security office, they're going to have, John's going to file for his benefit. He's going to get $2,000. Jane has two options. She can have all of hers, or she can elect to have half of John's. Now, where I come from, half of 2,000 is more than 800. So
only in Grantsville, right?
The digs on Grantsville. I saw my aunt and uncle on this call, and they live in Grantsville.
Oh, really? So we could be getting in trouble there too. Okay.
So Jane is going to get $1,000 a month, and regardless of what her benefit is, whether she has her own benefit or not, she is entitled to half of John's benefit just because she's married to him. So really, this $800 didn't really, it wasn't crucial for her to get a Social Security benefit. But that's how spousal benefits work. Now, if you're born 1953 or earlier, this is a strategy that we've been teaching for years. And in 2016, Social Security kind of pulled the rug out, and they took this opportunity away. It's called a restricted spousal benefit, but here's how it works. And if you're born 1953 or earlier, if you have a friend or a coworker that is, and they're not aware of this strategy, they need to call us right away. Let's pretend that Jane's benefit is $1,200 a month and John's is $2,000. Now he takes his own personal. Now Jane has two options. She can have all of hers or half of his. Well, $1,200 now supersedes the spousal benefit. And so most people would say, well, I'm just going to take the $1,200. I'm going to leave the spousal benefit on the table. But if Jane is born 1953 or earlier, she can actually take the spousal benefit at 66 and defer her own personal benefit, the $1,200, to age 70. And if you recall, on one of those previous slides, it showed you the delayed credits of 8%. If you don't take your benefit right at full retirement age, it's going to grow at 8% per year. And so Jane's $1,200 benefit is going to be growing by 8% in the background, so that when she's 70, she can go back in, revert to her own, and it's going to be worth about $1,600 to $1,700 a month, and she'll get that then for the rest of her life. So there's some really unique strategies here. This scenario is assuming that they're both married. If they're divorced, there's a different set of rules that play in. And so, if you're divorced, as long as that marriage lasted at least 10 years, then you could be entitled to divorced spousal benefits.
Couple questions here. We had, if you're on a spousal benefit now, do you have to cancel when you turn 70 to take your own benefit? Is it automatic, or do I notify Social Security Administration that I'm doing it? I always have my clients notify Social Security Administration. I've heard conflicting information about this, but I've never left it to chance. Just file for your own benefit at 70, don't you think?
Zacc, it's actually a whole new application. So what they have to do is they have to log into the Social Security Administration and file a brand new app as if you had never filed before. And that is what triggers the switch from a spousal to your personal benefit.
Just to keep things easy, right?
That's right.
and then another question here was, can a former spouse apply for half of my benefit if my current spouse is getting half of my benefit? And we do know the answer is yes, as long as certain criteria have been met, like you have to have been married for 10 years. And at certain, you can't be remarried after a certain age anyway, or before 60, I think it is. Anyway, we do see every once in a while where you might have someone who has 3 former spouses receiving a spousal benefit, draining the Social Security system, right?
Yeah, that's exactly right. Keep track of your ex-spouses.
It doesn't matter.
And
actually, you don't.
Good point.
You don't need to keep track of them. Move on. It won't affect anybody's benefit. The Social Security Administration will handle all that.
But this is a good point. If you're married 3 different times for a decade and you are entitled to a divorced spousal, you could go back and look at each 3 of those and say, which one had the highest earnings, and your spousal benefit, divorce spousal benefit, would be based on the largest of those 3.
Right. I had a lady who was divorced twice and remarried. She was remarried after 60, so she could pick between her current spouse's benefit, a survivor benefit. She had all these different options. One of the people she was divorced from he had passed away, and the other one had not. And then she had her own benefit. We were trying to strategize between almost 4 different benefits, and it wasn't just which one; it was which one at which time. We did one and then did the other, and then moved on. Which I think we've got a couple of examples here, but like this is similar here. If you've got Kathy in here as an example, divorced, marriage was 10 years long. She has a divorced spousal benefit. She has her personal benefit. And this is where she could pick up maybe that divorced spousal for a while.
Yeah, I changed the name here. So Kathy's not on the call today, but I changed her name for privacy. This is a retiree from a school district that we worked with. When I met with her, Zacc, she was 67 and a half. A year and a half earlier, when she was 66, she went into the Social Security Administration because she had heard that, hey, I was married for at least a decade. I think there's some divorce spousal benefits I can get. When she went in and she talked to the administration, they said, no, you're not entitled to anything, or something along the lines of it's not worth your time. And so she left thinking that she had received correct information. Well, I met with her a year and a half later and quickly realized, no, you got bad advice, and it's cost you thousands of dollars. And so we quickly filed for a divorced spousal benefit, and she immediately started picking up $1,300 per month. We were able to get a back payment of $7,800, but what she missed there at the bottom, $15,600. There's no recourse for that. No. There's no way of going back and getting that. You can't go in and say, hey, I got bad advice from you guys. I need you to make this right. They're going to laugh and say, no.
Right. Leave them a bad Google review. That's about all you've got in your pocket at that point.
1-star review.
1-star reviews. Do you want to chat about this is Survivor?
Yeah, just real quick. Survivor benefits. Again, you've got spousal benefits while both spouses are alive, whether it's a current or divorced spouse. Survivor benefits come into play when one of these spouses has passed away, whether it's a current spouse or a divorced spouse. In this case, we have Julie and Joe. Julie's Social Security benefit is $2,000. Joe's benefit is $1,200. If one of them dies, and we're just going to pretend Julie passes away in this scenario, then Joe is going to drop his $1,200 a month, and he is going to inherit Julie's $2,000 per month. It is as simple as that. Sometimes we try to complicate the survivor benefit, but the surviving spouse is entitled to the largest of the 2 benefits. And so, Zacc, a lot of times in our planning, what we try to encourage retirees to do is that primary breadwinner, in this case, Julie, she should try, if possible, to delay that if it makes sense mathematically, to delay it so that she can get those 8% delayed credits, maximize her benefit. And so that, if she passes away, Joe gets that benefit, or she gets to keep that larger benefit realizing and understanding that she's going to at least lose the $1,200 a month at some point in time.
We had a question here. Is the spousal benefit a half of the PIA if the primary worker starts taking Social Security before their full retirement age? And it's a great question. There's a it depends in there, but I mean the short answer is yes, but it also depends on the spouse's age when they elect that spousal benefit. So so in other words, you don't get reduced because the primary worker took it early. You would get reduced because you took it early. So instead of it being half, it might be only 30 to 35% of that benefit. So it's more based on your own age as the spouse than on your spouse's age. Sometimes there can be some strategies there where if there's a big difference in ages, the older spouse can file for their own and open doors, or the younger spouse can file for their own right away at 62, and then the older spouse can pick up half because of their own age is full retirement instead of early. So you can definitely get pretty strategic about this. And there's not enough time today to go through all of the different strategies, but what I do want to point out is I want to show you the two biggest Social Security decision mistakes that we're seeing, and then go through those, and then we'll probably save a good 10 minutes or so. We'll just answer questions at the end. And just know, if you have questions about this, you can contact us. I mean, we have about 8 advisors now. I mean, we have people, our compliance officer is advisor and compliance officer. We've got a lot of people that know this really well in and out. This is Capita's thing. Social Security is our thing. If you have questions, call us. We'd be happy to answer them. And most of you on the call already have 2 dedicated advisors to you. That's our method here at Capita. Okay, so let's dive into the 2 biggest Social Security decision mistakes. And they are your break-even age is being calculated wrong, and not understanding the tax ramifications of Social Security income once you're receiving it in retirement. So the break-even age is really how long do you have to live to catch up for delaying your benefits. If you're delaying your benefits and comparing that with taking Social Security early, then there's this benefit of taking it earlier. You're getting money in your pocket right away, and you're waiting for a while, but it'll be a bigger benefit later. And once those 2 benefits add up to each other, the total dollar amounts received, we call this a straight break even. And most people do a straight break even reasonably well. Sometimes they forget to calculate cost of living adjustments, but most people do it okay. That's not the mistake. I'm going to show you the mistake here in just a minute. A couple things to consider when you are doing a break-even analysis is sometimes a married couple, they might do one spouse's break-even analysis and then the other spouse's break-even analysis, make decisions independently of each other. And sometimes we have to do that because people manage their cash flow so separately that it's hard to almost sacrifice one benefit for the other person's cash flow. But if you manage your cash flow jointly, Social Security is a team sport, and you need to consider both benefits in the break-even analysis. The example that Tyler gave called a restricted spousal benefit, that's one where you for sure need to consider both benefits because you're picking up, in a sense, some free money while you're waiting for benefits to grow. And that should be factored into the break-even analysis. The second thing that people forget is they forget that those cost of living adjustments. So you have to throw in we're starting to get into the mistakes on break-even analysis. So the cost of living adjustments, you need to factor in some growth on those payments over time. And the biggest mistake, this is the one that we couldn't find software to figure this out. Like this is the one that I've yet to see any reasonable software to help financial advisors, which is the money not earned on the assets that you had to withdraw when you were waiting. So let's see if I can say that in a different way, because that's a mouthful. If you decide to wait on your Social Security and you have to get that income from someplace, instead of pulling it from the Social Security pocket, you're pulling it from the 401k pocket. And then as you pull that $2,000 a month from your 401k every month, you are taking away some interest. Now, don't get me wrong, it's not a lot. Nobody's earning a lot on interest, right? But maybe there's growth on stocks and bonds and things, right? So that $2,000 a month is being taken from your portfolio, doesn't have a chance to grow. And depending on how aggressively or conservatively you invest, therefore how much interest you earn on your money, that factors in because that money exists if you took Social Security early because you didn't have to withdraw from your account. It does not exist if you took Social Security late because you took it from your portfolio before it could earn it. So the interest on money withdrawn from your portfolio is something you miss if you wait. So here's an example. Fake person George at 62 takes Social Security and he's picking up $2,100 a month. Or George could wait until full retirement. This is a pretty high earning individual and get about $3,200 a month. So for 5 years, he's receiving almost $25,000 a year, $25,000 a year. So this is money that if he goes with Social Security early, he does not have to take from his IRAs, 401ks, and other portfolio. If he goes at normal retirement age, we've got to create that money from someplace. And in many cases, it makes sense to withdraw from your accounts and delay Social Security. We've talked about the benefits of cost of living adjustments, right? And then let's just show you how this works for this person. So the money not withdrawn is and we've got a slide here. If you're listening to this without the visual, just understand we've got a slide here showing, hey, this is money not withdrawn, and then you finally start getting a larger benefit. But by year 4 or 5, if you take Social Security early, this George is about $132,000 ahead. And then it starts to get, that difference gets chipped away at each month because of the higher Social Security benefit. And in about 15 years, this straight break even is done. George has earned all $132,000 back. Now, we haven't quite figured in the cost of not making that money. So the first year, he does not have to withdraw $25,000 because he's getting that from Social Security. If he were to get 8% growth, then he would have an extra $2,000 in his account because of that. And then after 2 years, there's another $25,000 to $30,000 not withdrawn, plus the first year's interest and the second year's interest. Now, the compounding effect of the second year's interest is $6,000, right? So it starts to compound and starts to make a real difference. If George earns 3% on his money, the break even gets pushed out by about 3 years. So this is where I say, if you have a low risk tolerance, it probably makes sense to actually still wait on Social Security because you're not earning enough to make that big of a difference in the break even. But let's throw, instead of a 3% growth rate, let's throw an 8% growth rate. We've now pushed this out to something like 40, the chart shows about 48 years. George will be 100 and something. I think it was like 114 or something like that. Anyway, George would be over 100 years old before he caught up if he was able to earn 8% growth. And I have a couple of clients that have come to me, usually engineer types, accountants. They caught this on their own, never found anybody to analyze it. We analyze it for them, and they end up taking Social Security at 62 because they're a high risk tolerant individual. And they say, yeah, I expect to earn 5, 6, 7, 8, 9% on my money. And therefore my break even is truly way out there because I can earn growth on those dollars invested in my retirement plan. So this is mistake number 1. People not factoring in all of the variables in this Social Security break-even age. They just add up the dollars received and say, oh, at this age, I'm good. I've received the same amount. But that's not perfectly equal, all things being said.
Leave it to Zacc to solve the most complex question.
This is where I live, right?
Zacc is the master of all complex questions here in our office.
It's like a puzzle. It's like a fun puzzle for me to try to figure out. But we do have a couple questions. I am going to hit those in a few minutes here. Let's just make sure. Oh, so Tyler mentioned restricted spousal benefits, said that Social Security had pulled the rug out. You can't take a restricted spousal benefit anymore. You can take a spousal benefit. So we want to be clear here. You can still get a spousal benefit. You just can't choose anymore between, if you're born 1954 or later, you can't say, I've got both options, my own benefit and a spousal, and I'm going to pick the spousal and delay my own and let it grow. You can't do that anymore. If you go and file and you have both of these benefits, the Social Security Administration is going to force you on the larger of the two. That's what they took away. They call that deemed filing. Yep. So that's one change that we had a question about somebody at 74 years old, retired, widowed, receiving Social Security. What can be done to enhance the benefit? It's always worth us just doing a quick review. I know the individual here who asked the question, my gut I've already talked with you about it. I'm guessing that there's not much, but we'd be happy to look at it again. Once you hit that age, most of the time, you're kind of locked in. I mean, there's not a lot you can do other than live as long as possible. Just take care of yourself, right?
I will say, Zacc, that the Social Security Administration is not mistake-free. It's always worth a check. We have had retirees that are in their 80s and on what they thought was a survivor benefit, but the Social Security Administration never switched them over. So it is good just to double check.
Right. Question: if you're divorced and your ex-spouse dies, can you switch to his benefit? This is a it depends question, and if you are remarried and at what age you got remarried, so that can change the eligibility on that. But the short answer is yes, as long as those other criteria are met. And it's kind of a weird thing in our conversations. Every once in a while, we'll tell people, you've been divorced. Okay, is that person still alive? And sometimes they'll say, I don't know, or I think so, and we'll have to kind of tell them, could you at least keep tabs on that individual and let us know if he or she passes away? Because in many cases, you can get a larger benefit. A survivor benefit is the full benefit, whereas a spousal benefit is half. So it definitely makes sense if you have an ex-spouse that passed away to revisit that with us. Question came in about, do we as financial advisors figure that out prior to having people determine to push their full retirement age to 70? I think what you're talking about there is, do we calculate the break even before we have people with the cost of growth? The answer is yes. So if you look at this slide here, this is an example of 3 different strategies. This is actually our tool that we had to build since we couldn't find good software for it.
Zacc built it.
And then, and we update this every year at about in between Christmas and New Year's. I go through and update all figures and rerun the numbers so our formulas work. But basically, this individual, their straight break even is 78 between strategy 1 and 2. Straight break even is 83 between strategy 2 and 3. So we have a couple here who has 3 different filing strategies. Again, if you're not looking at the visual, and then the cost of, I usually will throw in some moderate growth rate in there and let the client push it up and down if they want, but usually about 4.5% to 5%. And then this individual, it adds about 4 years between the first 2 strategies for the cost of money withdrawn from your portfolio and not getting that growth. It adds about a decade between strategy 2 and 3. So we do calculate that in. And I think a lot of people just in the past have said, go to 70, go to 70, go to 70. And it changes your opinion a little bit when you think about what you have to do to actually get there, right, from an impact to your retirement plan standpoint. But I have been proud of our advisors that we try to take a really good mathematical approach to it and give you the details and let you make a decision. All right, Social Security mistake number 2. And this is not understanding how taxes apply, how income tax applies to your Social Security benefit once you're receiving it. And I don't blame anybody for not understanding this because it's tough and it takes a while to really fully understand it. So the way that they do this is they take your Social Security benefit and then they run it through 2 formulas. Without going into too much detail, they create something called provisional income, which is half of your Social Security plus all your other income plus tax-exempt interest. And they run it through about 2 thresholds, depending on your filing status. That's the complex side. So the left side of this equation is complex. Do not try to do this right now. I'm just giving you concept here. The left side is more complex. The right side is 85% of benefits. So if you have Social Security, they will say, let's say you're receiving Social Security, they'll say, okay, we'll just tax 85% of it. Let's talk about the inverse of how you would say that. That means no matter what, 15% of your Social Security income is coming back to you tax-free. That's the way to understand that. More of it might come back tax-free if, when running through the left side here, the thresholds of about, for a joint couple, $32,000 and $44,000 with what's called provisional income. And again, we have our calculators for this. But rather than try to teach you and have you memorize this, I just want to show you a couple of examples of how this works. So we call this the Social Security Accelerator. So an example would be someone who has about $25,000 of adjusted gross income, not including their Social Security. This is like pension, IRA withdrawals, 401k withdrawals, interest, other things like that. and then about $30,000 of Social Security income. In that case, they only have to include 13% of that $30,000. So in other words, they only have to include $4,000. I don't think a lot of people realize how sweet of a deal that is, because you take $25,000 of regular income plus $4,000 of Social Security income, they're at $29,000. Then a standard deduction will wipe away most all of that, and they're almost paying a zero tax that year. Yeah. They're almost paying a zero tax with $55,000 of income. Yeah. And we find that a lot of our retirees, maybe they have accounts that are not IRAs and 401ks. So they could actually withdraw from those since they've already paid taxes on them. And they may actually be spending $75,000 a year, even though they're only showing $55,000 a year. Anyway, there's some really cool strategy there. Now, we're hearing on the radio and there's this big blitz to say, you got to convert everything to a Roth, which we think is a mistake. But we hear it a lot, and we hear it from our clients. So every time a bunch of marketing goes out, we don't do a lot of marketing like that. I just have the podcast. And believe me, we're not making any money on the podcast. But anyway, whenever we get a lot of questions back, we know that Saturday Radio has been talking about Roth conversions. So true. But anyway, so here we see that. So like, let's say that somebody did a $20,000 Roth conversion. Down below, it's showing $45,000 of adjusted gross income. Here is the kicker. This is tough because adding the $20,000 of that Roth conversion, it wasn't just $20,000 more of income. They had to add the 20, plus they had to add about $15,000 more of their Social Security. You see, it went from being taxed only 13% of it, now 65% of it is showing up because of that, we call it the accelerator. Now, more income going into that equation and on the left side, and now the result is 65% of benefits instead of 13% of benefits. So someone who does a $20,000 Roth conversion actually added almost $40,000 of income. And they're thinking, I got a sweet deal. I was only paying 12% tax on this Roth conversion, when in reality, they paid 12% on 40,000 instead of 12% on 20. That's about a 24% true cost of the Roth conversion. So once again, we have tax software that we use. We even have tax software to read your tax return. We've started doing this for a lot of people. If they'd like us to help with their taxes and understand taxes, we can take the PDF, throw it in our software, and it gives us ideas. And then it also gives us a tool to be able to throw in different scenarios and give you an idea as to what it would do to all of these things, like Social Security taxation, if we did a Roth conversion. All right, let's just show you the chart. So here it is across the top. And again, if you are just listening to this, I would say hop on, because this chart is perfect to be able to understand really how much of your Social Security is going to be taxed. But across the top, each column is how much Social Security income you have, and then each row is how much other income you have. So someone who has $40,000 of Social Security income, this is a couple, and $30,000 of other income only has to, you find the cross section there, they only have to include 28% of their Social Security. Once again, that is crazy. $70,000 of income per year. They only have to include a little over $10,000 of that Social Security income. So they're really only showing $40,000 of income, standard deduction of about $27,000 off of that. And they're really paying like about $1,500 in taxes for the year. Yeah. So this is also like a soapbox I'll get up on and then I'll get back off. But I hear a lot of people freaking out about taxes in retirement, when the exact opposite is what we see for most of our clients, that their tax rate in their working years is way worse. I know a couple of you are on the call who are getting hit pretty hard on taxes. And they're like, well, Zacc, that's not true for me. But I know, well, congratulations, you're winning. Like you have a lot of money. But the point is, for most people, income tax is a whole lot better in retirement than it is when you're working. This is the same chart for a single person. And you just hit the 85% a little bit quicker on most of the table. Let's chat about the next step, which is Part B premiums, and a little bit about taxation overall. And then we got to throw in the questions. In fact, right now, we got 5 minutes. Start throwing them in. I'm going to talk. We have been answering them as we go, but throw in any questions you have here. And I'll just keep talking for just a second and we'll tackle any questions that come through. The bottom line on this is your Part B premiums go up if you have more total income. The first line for a couple is $176,000, and then for an individual is $88,000. So you're paying that $148.50, and then if it goes above $176,000, now your Part B premium will be $207. So that's a painful bite there. $60 a month per person for a couple, you're $1,500 roughly a year. It's something to keep in mind. You can appeal this if you have a major life event. There are about 8 of them, but the most common one we see is work stoppage. So if you are retiring, don't pay that higher benefit if your income was $250, $300 in working years and you're dropping down to $150 in retirement. You can immediately appeal that and get an exception and drop down to the $148. You're throwing away a couple $1,000 if you don't. They delay it for 2 years. What were you going to say?
Yeah, I was just going to say it's a 2-year look back. So in 2021, they're looking back 2 years to 2019 they're looking at that modified adjusted gross income to determine what your premium is going to be for 2021.
Oh, and I got a great question from somebody I know really well saying here, are you saying there's no meaningful role for a Roth in your tax strategy? No, absolutely not saying that. I think we do more Roth conversions than I think most financial advisors do. We just don't pitch, convert everything to a Roth because most of the time it looks like this. Let me show you. So we call this test tube taxes. We work closely with a lot of medical professionals as well. This type of individual, this red test tube on the far left is regular income rates. And then the blue in the middle is capital gain rates. The green is Roth and HSA withdrawal rates. The 2 black test tubes are healthcare related, Part B or a healthcare subsidy on the Exchange of Affordable Care Act. This person, if this is how much income they're showing, we would absolutely look at a Roth conversion to fill up the 12% tax bracket. So if you have some headroom inside the 12% tax bracket, we would seriously consider looking at a Roth conversion in that space. But we would also want to be aware of what that's going to do to your Social Security taxation. Depending on the composition of your income, how much of it's Social Security versus other income, it may not have any impact at all on how much of your Social Security is being taxed, or it may really accelerate how much of your Social Security is being taxed. We just want to be aware of that before we go in and do a Roth conversion. But I've done Roth conversions from anywhere from 10,000 to 175 in the last 3 weeks. And that's just depending on what brackets people are in. And that person with 175 is really trying to fill up the 10, 12, and 22% tax brackets, but not much more. And then so the next thought there is if you have somebody who is close to that 22%, filling up that entire 22% tax bracket, now we're really worried about Medicare Part B lines, and we'd want to be aware of that line as well. So it's really just good tax planning is what we call it is marginal tax bracket management, being aware of about 6 or 7 different lines that might apply to you and understanding, if we add $1 here, what does it do over there? And which levers are automatically moving when I pull this one.
And the software we have does a great job of helping us analyze that.
Right. We like that a lot. Throwing the tax return in and being able to quickly see where everybody is on capital gains rates and income rates and Medicare Part B and anything that may change. Now, if you have assets that are IRA assets, 401k assets, maybe you have some Roth. So going back to this question, does a Roth have a meaningful purpose in retirement planning? Absolutely. And to me, it's less about getting everything on one side of the ledger or the other and more about having options. So we're seeing here, for example, an ideal prepared retiree might have the ability to fill up to $80,000 of regular income. And then maybe they have the ability to take 15% capital gains rates instead of 22% additional withdrawals from their IRA. So they can stop the IRA withdrawals at 80, do capital gains at 15, and then top off with a Roth withdrawal on top of that. So that I also look at it, I fund all of them personally in my working years, I fund them all. So that in retirement, if we decide it's time to buy a car, I can tap one of those low income sources if I run into a higher marginal income line. So it's all about marginal tax bracket management. We are up on the hour, and I think we took most of the calls. I saw we have 14, most of the questions, 14 questions that got answered throughout, and I think that's great. And that's just in the Q&A, a couple more in the chat. If you do have additional questions, know that that's what we're here for. And I had a couple questions come through that were very specific to an individual, like I'm turning 67, should I file? You can see we need to know more about your spouse. We need to know more about the exact dollar amounts, your PIA, and your earnings, so we don't get tested and have penalties. We've got to make sure that we cover all of that and give you good guidance on how to file for Social Security. And we'll give you the break even with and without the growth, help you make a decision, and you can move forward. But this has been really good. Again, there's a phone number for us. If you want, hop on thefinancialcall.com. There's a ton of content like this. Tyler, anything else to add before we wrap up?
No, I think that was great. Thanks for joining us.
Good to have the expert on. Thank you.
Thanks, Zacc.
The opinions expressed in this program are for general informational purposes only and should not be considered as advice or a recommendation. Opinions expressed by guests do not necessarily reflect the opinion of Capita Financial Network. Past performance discussed is no guarantee of future results. Capita Financial Network does not provide tax or legal advice. If you have further questions, please contact your financial advisor.